In politics and money, the relationship between the Federal Reserve Chairman and the President of the United States. Let's bring in Rob Stein, the CEO of Astor Investment Management. And you worked at the Fed under Paul Volcker. What can you tell us? Because people may wonder how much the President of the U.S. is involved with the Fed.
Well, the President is an important component because it gets to select who the chairman of the Fed is, generally from a pool, and Congress has to, of course, confirm that. But it's built to be an independent body. The Federal Reserve is not, believe it or not, a government agency. It's owned by the member banks. The Federal Reserve Chairman is appointed, but they're supposed to be able to act independently, raise and lower interest rates, look at money supply numbers. They can't create money. That can only come from the Treasury, from a bill from Congress. But they kind of act as the bank to banks and help the money flow to the banks by moving the interest rates up and down between the member banks and allowing the banks to lend the money out to the economy.
How critical is it for the Fed to gauge policies coming out of Washington to keep the economy running smoothly?
Right. So the Fed has a mandate, dual mandate, inflation targeted at some level. It's around 2%, but they've said they're going to let that float a little bit above that, and full employment, whatever the definition of full employment. And recently employment's gotten back to levels pre-pandemic, below 4%. So what they're supposed to do is stimulate the economy when unemployment is rising. Lower interest rates encourage banks to loan and give the economy kind of a jolt. And when the economy is overheating or inflation is picking up, they're supposed to raise rates, make it harder to spend, more incentive to save, and slow the economy down. You're in a situation right now where the Fed and the Treasury have worked together to put money out into the system. Lots of money, a lot of money tends to create inflation. And the Fed now has to decide, are they going to put the brakes on? And there's a lot of complicated technical ways they can do that by repurchasing their own bonds, reducing their balance sheet. But generally it's done, Angie, through raising and lowering interest rates. And so there's so much money out there. The economy is starting to overheat. Inflation is high. The Fed is saying that they're going to raise interest rates slightly sometime in 2022.
Do you think, as the Fed is raising rates this year, it will be painful for consumers?
I don't. I think mortgage rates will stay about where they are. They'll start to go up a little bit. 10-year mortgages will start to go up a little bit. But in 2023, I do think that you'll start to see those rates impacting consumers. You might even get the prime rate to move. I expect mortgage rates to come off of these very, very low levels and start to go back the other way. So I would start looking at your consumer rates and getting ready to lock in the rates that we see right now.
Good advice. We always appreciate your commentary. Thank you very much.
Thank you, Angie. See you next time.
Go to businessfirstam.com for where to see our show on TV.